millions of people are running as fast as they physically can right now. They're working longer hours, picking up extra shifts, maybe even getting decent raises, only to realize they are still falling further and further behind. And it is not because they're suddenly making terrible financial choices. It's because the entire structural foundation of how we price basic existence in this country has completely broken down. Think about that gut-wrenching drop in your stomach when you check the mail and see the utility envelope. For 49% of American families, the ultimate luxury isn't a vacation to Hawaii or a brand new car anymore. It's just keeping the lights on. We are watching this massive systemic breakdown of the 2026 middle class. It's this brutal K-shaped squeeze where, sure, maybe your paycheck went up a bit, but it is instantly being swallowed whole by invisible taxes you literally cannot opt out of. 49%. Nearly half the country lacks the resources to cover essential daily expenses. Just let that sink in for a second. We're not talking about a minor economic dip or a temporary recession. That is an entire segment of the population where the mathematical reality of daily life just does not work anymore. There's a profound psychological shift happening right now. The American dream used to be about getting ahead, right? Building wealth. Now, it's just about trying not to get evicted by your own utility bill. People aren't playing to win anymore. They are playing pure defense against the local power company. And honestly, that fear is entirely justified because there is an absolute outrage hidden deep inside those monthly bills. It's something called the infrastructure AI paradox. We constantly hear about how artificial intelligence is this glorious economic savior, but right now it is acting as a massive hidden tax directly on your checking account. You look at your bill and the power you actually consumed yourself, it's barely half the cost. Middle-class families are unwittingly bankrolling the tech industry's massive computer brains. Utilities are aggressively expanding the electrical grid just to support these new, incredibly power-hungry AI data centers. And guess who they're passing those billions in capital expenditures to? You. In so many areas, the delivery charges and those vague fixed systems fees are actually higher than the cost of the electricity you use to run your own house. Regulators just recently approved 43 major rate hikes, dumping $11.6 billion in brand new costs onto 56 million Americans. You're subsidizing a multi-billion-dollar tech boom just by turning on your kitchen lights. Congratulations, you're an angel investor now. You just don't get any of the equity, which has led to a shocking 12-point surge in energy insecurity among households making between $60,000 and $200,000 a year. Let that breathe for a moment. A family making $200,000 is now actively stressed out about running the air conditioning. We are seeing families sitting in perfectly well-insulated, energy-efficient homes struggling just as much as anyone else, simply because the base rates themselves are exploding. This crisis completely broke out of the low-income brackets and is dragging the upper middle class right down with it. Zooming out to the macro level, the math engine driving all this pain is simple, but it is brutal. Headline inflation is weighted heavily by the volatile energy sector. Geopolitical instability in the Middle East, specifically the escalating conflict with Iran, created a massive supply-driven oil shock. We saw gasoline jump over 21% in a single month recently. And that supply shock acts like a direct, regressive tax on your mobility. It drives up the baseline costs of absolutely everything, from your morning commute to the diesel required to get groceries onto your local store shelves. But as bad as that energy trap is, the housing market is undergoing an outright actuarial collapse. There is a legal loophole called the reinsurance pass-through, and it essentially treats the housing market like a rigged casino where the homeowner absorbs all the losses. Global insurance companies are losing billions to natural disasters worldwide, so they drastically increase rates on primary insurers. And those primary insurers are legally allowed to dump those exact costs directly onto your premium. And this isn't just some coastal problem. Yes, California is facing a projected 16% increase because of wildfires, but the heartland isn't spared at all. Nebraska is staring down a 13% jump driven by severe convective storms and hail. Georgia is up 10% for wind and tornadoes. Nowhere is safe. This absolute actuarial volatility is forcing hundreds of thousands of people into incredibly expensive state-run plans of last resort. It's making homes effectively unmortgageable and leaving regular families exactly one bad storm away from total ruin. Which brings us to a reality that is genuinely hard to process. 42% of the middle class cannot afford a $5,000 emergency. The liquidity is simply gone. When your baseline costs for shelter, insurance, and utilities skyrocket all at exactly the same time, your financial resilience just vanishes. Because they lack the cash, the modern standard of living is now being financed entirely by debt, and household balance sheets are finally snapping under the pressure. We're seeing credit card delinquency hit 5.6%, auto loan delinquency hitting 5.7%. Consumers are putting basic groceries on plastic just to survive to the end of the month, and those compounding interest rates are locking the trap shut. But just when the despair starts to feel completely permanent, a sudden, massive shockwave is coming out of Washington. We are seeing a rare, hyper-aggressive, fully bipartisan response to the chronic housing deficit that pushed the average home price near $500,000. Congress introduced the 21st Century Road to Housing Act, and the features of this bill are a stunning departure from business as usual. It directly targets institutional investors. It literally bans corporations that own more than 350 homes from purchasing any new single-family properties. And if they build for the rental market, they are legally forced to sell those assets to actual individual families after 7 years. This is a massive political shift to forcibly detach Wall Street hoarders from the starter home market. The absolute contrast in approaches here is wild. While Congress is heavily targeting Wall Street hoarders through those legislative bans, the Trump administration has unleashed this executive deregulation strategy. They're using executive orders to slash environmental review timelines under NEPA, eliminating what they call unduly burdensome energy and water use requirements. The entire goal is to fast-track construction, force a massive surge in housing supply, and break the pricing fever. But until those houses are actually built and those prices finally drop, the psychological toll on the average voter is devastating. 67% of Americans are now more terrified of running out of money than they are of dying. That is the true human cost of this K-shaped economy. The sheer anxiety of outliving your resources or just failing to pay the next unavoidable bill has officially superseded the most primal human fear. And that raw terror guarantees the 2026 midterms will be an absolute bloodbath for sitting politicians. Citizens are voting entirely based on their out-of-control, non-negotiable monthly costs. Democrats are going on the offensive, attacking corporate greed and pushing to restore major healthcare subsidies to lower premiums. Republicans are actively countering, blaming excessive government spending and arguing that green energy building requirements are inherently inflationary. The electorate is skeptical, they are exhausted, and they are desperately looking for anyone who can actually lower the cost of merely existing. So it leaves us with the ultimate question for this economy. Is it fair for middle-class families to see their utility bills spike just to subsidize the massive electrical needs of AI data centers for multi-billion-dollar tech corporations?
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.